Well, again, thank you everybody for coming. We really appreciate everybody getting up early this morning. I was laughing to myself between it looking foggy and slightly cool this morning. I was like, okay, this is a morning where you need a really nice, warm cup of coffee, sit outside and kind of enjoy our 2 days of fall that we have here in Dallas. And so this is one of them. Okay, but at least it's finally quit raining for a while. We're delighted to have everybody this morning. We're going to work through and do a few different things this morning. But first off, I just want to tell you again, thank you so much for coming. As most of you know, we are always out. We're doing these events regularly throughout the year, but we're always looking for clients. If you know people who need help, whether it's in the compliance area with tax or audit work or financial reporting, we also do a lot of advisory. White Rock Advisors, our investment banking group, are very active in the M&A sell side, corporate finance, sub-debt mezz area, just rebuilding the whole cap stack, and then our wealth management team. This morning, we've got somebody from every group that's here, all the different disciplines. Mark Levine is going to be our speaker this morning. I'll introduce him in a minute. But we're going to change the format up a little bit in that we're going to let Mark talk for 30 minutes, 35 minutes about tax law changes, things that are in process, that kind of stuff. But then we're going to stop, and as part of the Q&A, we're going to bring the whole panel of us up with what you want to ask. If you're in questions about financial reporting, whether it has to do with M&A, corporate finance. Simon Martin will be up there from White Rock. Chris Jeffers is going to be up from our wealth management group to talk about year-end investments, that kind of stuff. You've got questions. We wanted to make the whole team available to you at our senior management level and stuff, so that if you had questions about anything related to year-end, you would either have met the person today or have a chance to ask the questions today. So hopefully that format will be helpful. We always have felt like that October was the time to start thinking about these things, so that we still have 60 days or so to do planning and changes, that kind of stuff. By the time we get down to Thanksgiving and stuff, the year end's pretty much set. Between holidays and everything going on, people are not really focused on year end, and it's really too late to start doing a lot of planning and putting things in place. So we wanted to make the whole team available today. We also have Nathan Risk is here, one of our other seniors from our tax group and stuff too. So feel like good to grab somebody if you've got questions afterwards too. And we don't get to yours in the Q&A. We're delighted to stick around for a few minutes. We do try and get everybody out of here at 9 o'clock. And again, we really appreciate you coming and spending some time with us this morning. And feel free to, if you want some more coffee, something else, go out, help yourself, come back in. We also want to thank our admin group, Andrea and JC, and the folks from the firm that come and help set this up and stuff each month. Please tell them thank you. We'll have parking and other things we'll talk about at the end as we wind up this morning. We also, for those of you who've been with us for a while and come to other events, know that we like to kind of highlight a nonprofit and stuff. And today we've got Rod Riggins here from Dallas Foundation to talk just a few minutes about what they do to expose you to somebody out in the community and what they're doing and how they're touching things. So we'll let you visit for just a few minutes, and then we'll jump into our regular program.
Thanks, Greg. I appreciate the opportunity. Speaking of teams, a couple of my teammates are here. I just wanted to introduce them in the middle of as they're chewing back there. Haley McCollum is a relatively new member of our team, just about a month. And she smiles a lot, but she's not smiling as much this week because she's an OU grad. Sitting next to her is Kim Montez, who you can talk to afterwards about planning. And she went to Texas, so she's been smiling.
Stop perimeter.
How many UT people do we have in here? Probably more than we have OU. How many OU? Any? Oh, good. Okay. All right. So we have representation from both. As he said, my name's Rod Riggins. I've been in Dallas since 1978 when I moved here to get my MBA at SMU after NROTC scholarship, Navy scholarship to Vanderbilt, and 4 years active duty in the Navy. I worked with a lot of people exactly like you for more than 25 years in private wealth management. So I worked with senior corporate executives and business owners, and my job in those days was to help business owners do the best job in estate planning, wealth management, working with good people at Chapman Hex and folks like that. 3 years ago, I like to say I changed to the bright side and moved over to the Dallas Foundation, the nonprofit world. I feel like I'm still trying to do this, almost the same thing. We're still helping people with their estate planning, but from the point of view of how can they do the best job for them and their families in their charitable giving, which means the best tax advantages, situations, and meet theirs and their family goals, whether it's immediate family goals or whether it's creating a lifetime and multi-generational legacy. And so I'm just going to give you two quick examples of some of our donors that are doing both of those things. This was introduced this week by a wealth manager to a 40-year-old, I call that a young man, who just started a business 18 months ago, already has $4 million a year in EBITDA, was offered $40 million for the company last week. He says, no, we're going fast enough. I think I'll wait for $100 million in a couple of years. But as you might imagine, he's got a big tax bill, income tax bill this year. He owns 100% of the company. So the wealth manager and I are talking to him about, well, of course you can just donate cash to a donor advised fund. How many of you guys have your own donor advised fund? Anybody? Terrific. With the Jewish Foundation, I'm sure. Good, Josh. And does everybody know what a donor advised fund is? Yes? Okay. Donor advised fund is a fund that anybody can open at a public charity. You get the tax deduction when you put the money with the public charity, but you're not required to give the money to operating agencies until you want to. Okay? So what this business owner can do this year to offset his big income tax bill is put as much as he wants in a donor advised fund, get the tax deduction this year, and then with his wife and children, his children are very young right now, but with his wife and family, decide where they want the money to go over the next 2, 3, 4, 5 years, or longer. Another thing we're talking to him about is putting 5% of his private company in a donor advised fund now. It's the big tax deduction based on the current valuation of the company. When he sells the company in 3, 4, 5 years, we, as a nonprofit public charity, don't pay any capital gains taxes on that. He ends up with a lot more money to give away, and in his case, it'll be enough to basically act as a private foundation for generations for his family. So real neat. I'm not trying to steal any tax ideas from Mark. Second one is a neat idea where we have a donor who has a non-taxable estate. Widow, $5 million estate, only $5 million estate. And she was going to leave a bequest for scholarship in her husband's name to honor her husband with the Dallas Foundation. We run 39 or 40 scholarship funds right now for different organizations and individuals. And we said, instead of leaving the $1 million for the scholarship straight to the Dallas Foundation, you have a non-taxable estate, you don't get any tax benefit from that. You trust your adult children. Yes, she does. So she's going to leave $500,000 to each of her 2 children. They are going to make the donation to the Dallas Foundation. They get gigantic income tax deductions for their income. They're actually going to be able to carry it forward for several years. They won't be paying income taxes for several years. Neat. Okay? So if you have an idea, if you have clients or yourselves, and you want to just talk about charitable planning, philanthropic legacies, please feel free to talk to any of the 3 of us afterwards. Thanks very much.
Thank you.
Well, appreciate it, Rod. Thanks so much for talking. Certainly, he'll be around today too if you want to ask some questions and stuff. In Q&A, if you want to ask Rod some questions too, please feel free. A couple of other housekeeping things. You do have a CPE evaluation form there, and also a speaker evaluation form. Please fill those out. Give them back to us at the end. Turn them in. We delight and covet that feedback and information you give us. It allows us to make sure we have programs that are on point and stuff. So let me introduce our speaker today. Mark has been with us for a number of years. Mark Levine has been in the tax area for over 10 years with federal, state, and local experience. He also has had a smile on his face since he graduated from the University of Miami. He's been smiling, very, very widely all week long, and we were laughing. He actually flew down this last weekend to see the whipping, that they put on, their opponent. So he's had a good week. But he's going to talk to us a little bit about today about this whole area with his master's in accounting and his tax experience. He has been just an unbelievable benefit to us in the practice in terms of helping us and talking to clients and stuff. We always laugh that He knows the code well, but he can talk to it without using code sections. And so you'll see that today. You were laughing. I think he only does it one time in the presentation today. So he tries to turn it into English, and that's really, really helpful for most of us. What he's going to talk on today is what we call your year-end checklist, and that's what today was all about, was what are the things you need to be thinking about for year-end. So Mark, come on up and let's talk about tax and planning. Thank you.
Thank you, Greg. So what I'm going to be trying to do is bring it down to kind of a level to go through stuff in a more macro kind of concept, so that we can kind of look at things that you need to look at while you're going through getting closer to year end. Things you can think about, especially with this year. This has been one of the, with the tax reform, things have changed quite a bit. So it's really important that you kind of know some of the things that have happened, some of the things that may be happening going forward, so that you can kind of think about it and start to plan and start to, figure out ways that you can possibly save on your taxes. Thinking about it, ahead of time. Now, tax returns, with the compliance aspect of things, is a historical thing. We take the numbers, what's happened, we put it on a tax return, and there's not much we can do at that point in time. So what we try and do with our clients is we try and get in front of them, talk to them about what's going on, see where they are, see where their financial situation is, and then think about, okay, what can we do within the next couple of months to try and make sure that we can reduce your tax liability, or plan for the next year, or maybe it's think about exit strategies when it comes to what you're thinking about in your business. Are you planning to get out of your business in 5 years? So those are some of the things that you have to think about ahead of time before it gets to the point where it's too late. So where I want to kind of start here is kind of what's on the list. This is kind of a mixture of things from an individual standpoint as well as a corporate standpoint, to things you can be thinking about, in the next couple of months going forward. So, starting with the new rates, everybody knows that the tax reform came in. They've changed not only the corporate rates, but they've changed the individual rates. So understanding where you fall into those individual rates is important when you're looking at the whole aspect of your tax return. What does it mean for your corporate situation, with the new 21% rate? And going into that, starting to manage year-end bills and receipts. If you're a cash-basis company, you want to make sure that you're pushing out the receipt of your receivables till beginning of the next year, and then you're paying off your bills at the end of the year to reduce that tax liability and bring your taxable income down. And that goes into the same thing here with accelerating or delaying income or deductions. There's various ways that you can plan and look at, starting now, thinking about it towards the end of the year, of managing your income or managing your deductions so that you reduce your taxable liability to a manageable point. That could be looking at bonuses. What are you going to be paying out at the end of the year? Making sure that you've planned accordingly so that you pay out those bonuses before the end of the year, so that you can take those deductions in your tax return. Or planning to make sure that if you're accrual basis, that you pay them within 2.5 months after the year end. Also looking at capital assets purchases. If you're planning on purchasing large quantities of assets in January, why not accelerate those, push them into the current year, buy them in December, so that you can accelerate those deductions in the current year. Sales of appreciated assets. If you're planning on selling something, or you're selling your business, structure it, plan it so that that occurs not at the end of the year in December, but try and push it into the beginning of the year to push that income out into the future. Tax loss harvesting, selling long-term capital losses to offset long-term capital gains. That's pretty straightforward. If you've sold some stocks during the year that has generated you some gains, why not look at your situation, see if there's any losses that you can harvest to offset those gains in the current year. And same thing with matching the passive income with passive losses on your individual return. And one of the biggest things that I'm going to be discussing later on throughout the presentation is the implication of the tax reform, the Tax Cuts and Jobs Act. This has become the biggest thing throughout the year. Everybody's been talking about it. They're starting to slowly, push out regulations to, analyze what it means, what it's going to do for you, and how to really look at what has happened. So we're going to be talking about some of the more impactful type items throughout the presentation. Similar to what he was referring to earlier, is looking at charitable gifting. instead of gifting cash, gift highly appreciable assets to take the benefit of this fair market value of those assets, and other areas where charitable gifting may be beneficial to you in your planning. Looking at your retirement contributions, making sure you're maxing out 401ks. Look at your SEP. Have you made your, what you're going to do, what the max amount's going to be, and how it's going to impact your return. Review the carry forwards for planning opportunities. Look at your NOLs. Look at the various things that you have in your return. Do you have passive losses that you can maybe get through recognizing some passive income? Looking at all of those opportunities now so that you can kind of plan towards the end of the year to try and get you have the best tax savings. Because like I said, once the end of the year comes, it's hard to go back and look at things and say, okay, let's try and do something now. We run into it all the time. People ask us, okay, what can I do about this? And we're like, when we're doing the tax return, we're limited in what we can do. So if you start going to your tax advisor now saying, this is where I'm at, this is what I'm looking at, you can better plan and actually execute things so that you actually end up getting the tax savings that you otherwise wouldn't. And one of the other areas here, life cycle changes. Has your filing status changed? Have you given birth? Are you moving? This goes not only from an individual standpoint, but also think about it from a corporate standpoint. Where are you in your business? Are you thinking about retiring? Are your kids going to take over your business, or do you need to start thinking about selling it? That could come in. Do you need to start to restructure and get yourself situated so that, not just necessarily this year, but 5 years down the line, you're in a position where you can actually exit your business in a reasonable manner. These are all things that you should be thinking about on a constant basis, that sometimes we forget about, and it comes down and it gets to the point where it may be too late. So now I'm going to get into a little bit more detail here from the changes that have occurred for businesses and things that you need to be looking at from, mainly with regard to the tax reform. First one, the biggest one everybody knows about is that the rates changed from the 35% to 21%. So this could mean that you have extra cash if you're in a taxable income position. What are you going to do with that? And it's going to, just kind of plan for that, you're going to have that benefit coming forward. Also, things to consider, and this is one of the bigger areas from a business perspective. We've talked about it with a lot of our clients. Every year we have clients asking us, okay, how much can I take from a 179 standpoint? How much do I need to buy to max that out? Well, one of the things that they've changed this year is the changes to the bonus rules, which in the past was limited to 50%. You could only deduct up to 50% of the assets that were purchased, and they had to be new assets. Well, they've changed the rules, and now not only can you deduct 100% of the asset up front if it qualifies under the bonus rules, but it also can be a used asset. It has to be purchased from a third party, but now they allow you to do new and used. So this kind of, when we were looking at it and I've been reviewing the things, people have been asking, well, what does that mean for 179? Should I take 179? Because if I can take 100% bonus, why not just take the 100% bonus and avoid having to deal with 179 issues? Well, there are certain changes that they did include with 179. The limitation is now up to $1 million, so you can deduct $1 million, and it starts to phase out when you get to $2.5 million of purchases. But one of the things that we've had some of our real estate clients talk to us about is they added HVACs, roofs, fire protection systems into the 179 rules. Those are not included within the bonus rules. So if you buy HVAC systems and you want to take the full deduction up front, you have to utilize the 179 rules. But with the $1 million threshold now, and with the rules with 179, you can actually pick and choose your assets and pick and choose how much of the asset you want to deduct, whereas bonus, you have to take all of the asset class if you elect into it. So those are some things to consider as we're moving towards the end of the year, thinking about your capital asset purchases that you're going to be purchasing and maximizing the deductions that are available. Other areas that they've made adjustments to is the like-kind exchange rules. They no longer allow automobiles. So if you have a business where you've got trucks and stuff like that, and you tend to exchange them at the end of the year and trade them in, you're going to have to recognize any gains on those trade-ins up front. They don't allow for like-kind exchanges anymore on that. It's just mainly real property. That also applies to airplanes, that you can no longer take the like-kind exchange on an airplane as well. Some other things to consider from a business perspective is, are you entering or exiting markets? What does this mean from a state tax perspective? Something that's overlooked a lot, when you're dealing with your business and you're looking at it from a tax perspective is, where are my state tax liabilities? Especially this is going to get impacted by the Wayfair case, which I'm going to talk about in a little bit. So it's always good to look at it every year. Have I entered into a new jurisdiction? What does that mean from state taxes? Am I going to owe extra taxes there where I didn't in the past? Some of the other changes here, the repeal of the AMT for businesses. This could be beneficial if you've paid AMT in the past. They're going to allow you to use that AMT credit against your taxable income in the current year, as well as if you don't have taxable income over the next 4 or 5 years, they're going to allow you to take a 50% refund of that amount. So that may be extra cash that's coming in if you do have AMT credits. So it's important to consider those kind of things. Some other minor items here, the dividends received deduction's been reduced. So if that's something that you've taken into consideration in your business before, it's something to consider. The domestic production activity with the new small business deduction that they allow for flow-throughs, it kind of replaced this deduction. This used to be the old Section 199, and now they have the 199A. So they've repealed that. They've made some changes to the R&D deductions. So it's important to consider if you've been taking R&D expenses, you may want to review to make sure that you're still going to get the maximum benefit that's allowed for that. So some of the other things that have changed with regard to the businesses is the business interest limitation. Now, if you haven't reviewed where you're at, one of the things that the Tax Reform Act did was they're trying to prevent high leverage companies. So what they did is they're only allowing you to deduct your interest expense up to a certain limit. Now, if you're a small business with gross receipts of 25 million or less, you can exempt yourself out of this. But it is important to consider whether or not you have high leverage, high debt, because if you have a high amount of interest expense that's driving you into maybe a taxable loss, you may be putting yourself into a taxable income position where you wouldn't necessarily think you would because of this limitation. So it's important to review the rules with regard to this, review where your situation is to make sure that you're not going to find yourself in a situation where you're owing tax when you weren't expecting it. The other changes, going forward, starting in 2018, your net operating loss is going to fall similar to what the old AMT rules were, where you're only allowed to deduct up to 80% of your taxable income each year. So if you generate NOLs starting in 2018 going forward, know that as you start to generate income, you're not going to be able to use that NOL to offset all of your taxable income. It's going to be limited. So in the past, where you plan to utilize those NOLs to offset your entire taxable income, that's not going to be the case going forward. So you may end up owing tax even though you have built up NOLs over the next couple of years. So these are things to consider as you're going forward and you're planning and trying to maybe get yourself to more of a break-even point than pushing yourself into large NOLs. So all of the techniques that we talked about in the past, we used to push, if you want to, buy heavy into your capital expenditures to generate an NOL so that you can utilize that going forward. These kind of strategies may need to shift and say, okay, well, let's try and make it so that we get ourselves to more of a break-even standpoint instead of putting ourselves into an NOL, so that we can try and flatline that so we don't run into the risk here of subjecting ourselves to taxable income because we've taken all those expenses up front. So these are kind of planning techniques, things to consider, larger changes within the tax reform from a corporate standpoint. So now talking about Wayfair, as I mentioned before, talking about state tax nexus. This is one of the things that I've read about it, it's come out. I haven't heard a lot of people talking about it yet. We're trying to get in front of all of our clients because from a sales tax perspective, this is going to start to become very big. What has happened is that back in 1992, there was a ruling that basically stated that in order to be subject to sales tax, you needed physical presence in a state. And what states were doing, they were losing out a lot of revenue because companies like Wayfair, who are online businesses situated in a state that doesn't have sales tax, which are just shipping their products to another state, are not being subject to sales tax. So what states have tried to do is find ways that they can kind of subject those companies to tax to increase their revenues. And what we're going to start to see, the ruling for the Wayfair case in North Dakota basically overturned that ruling and now allows for an economic presence. And what that means is basically if you're doing a certain amount of sales or a certain amount of transactions within a state, that state can now subject you to sales tax. Now, as you can imagine, this is wide encompassing because all the states have been looking at this. Some states have already kind of put the laws in place to follow what North Dakota had done, and many other states are going to do the same thing going forward. So it's very important to start identifying, okay, what states am I doing my sales in? How much sales do I have? How many transactions am I doing there? Because when you're looking at the Wayfair case, what they didn't actually establish the threshold for what's going to give you nexus in those states, but the threshold that they used in that case wasn't very high. It basically was that if the company had $100,000 in sales or 200 transactions, that gave you economic presence, and the state could now subject you to sales tax in North Dakota. Nevada, for just recently, passed very similar rules. They use the exact same thresholds of 100,000 to 200,000, but this is not fixed. So we're not exactly sure what states are going to try and do. Some states may try and go even lower than that, but this does establish kind of a starting point to look at where you have your sales. Do I have sales of over $100,000? Do I have more than 200 transactions? Because based on this case, you could now start to find yourself subject to sales tax in states you may not have been in before. The other implications this may have is it could also start to trickle into income taxes. Once they start getting out all of the new regulations regarding the sales tax, the next area they're going to start to look at is subjecting companies to income tax in states on the same types of economic presence. So again, this goes back to you need to look at where obligations may exist. What nexus study, looking at where do I have my sales, where do I generate a lot of transactions, what states do I need to consider, potentially where I might have a new sales tax, not only just the liability, but the filing obligations that may come along with this. Having to deal with sales tax registrations, sales tax filings in all these jurisdictions that you may not have been in the past. So it's very important to start to think about these things as we get closer to the end of the year, as states start to develop their new rules and start to implement them. The Nevada case that just recently came out that set their thresholds hasn't actually established when they're going to put the rule in place, but it's already been passed. So they are going to establish the same economic nexus standards that North Dakota did, or I should say South Dakota, is what the Wayfair case was. So it's important to just start thinking about that. Now getting into some of the individual areas. Again, the tax rates have changed, the brackets have changed. The new highest tax rate is 37%. So, seeing what that's going to impact for you, start to plan, start to look at your personal situation. The standard deductions have changed. They've increased to $24,000, but they've removed the exemptions. So no longer are you going to get, if you have 2, 3 kids, you no longer get the exemptions for them. What that means is it has an implication with all the other changes that they've done from an itemized deduction that you may no longer be in itemized deductions. So the benefits that you may have been getting before may go away because of the new higher standard deduction that you have. So things like that are start to look at, start to talk with your tax advisor. Are you going to be in itemized deduction still, or are you going to be one of the ones that falls back into the standard deduction? So all of those itemized deductions are kind of going to go to waste. Start to look at adjusting year-end withholding, making estimated tax payments. Now we've been talking to our clients all year about this. When we started doing extensions and everything like that, because of the new tax brackets, it's really difficult to kind of plan to where you're going to be. So some clients we've had have looked at it and said, okay, I want to base it off of 2018. So we've gone in and tried to do our best to calculate it, but we let them know that you may be under withheld just because of the fact that your liability from the prior year is going to be higher. So, if you haven't paid in enough, you're going to maybe subject to underestimated tax penalties. So things like that are start to look at to see if you've paid in enough. Defer income and accelerate expenses. I've talked about this before. If you have a Schedule C, a business run on a cash basis, think about trying to defer income not collecting until January, paying off all your bills in the current year, and trying to see where you can maximize your expenses when it comes to that. Same thing here, reviewing carry forwards. Do you have passive losses? Do you have NOLs? How can you utilize them? Looking at all your situation, capital loss carry forwards, everything, to try and see what you can do to maximize your situation. This is the time to do it, to start to look at it. As you're all, I don't know how many people here are filing on Monday, which is the tax deadline, but that's when you should start to look at it. Okay, this is where I was this year. Typically things kind of stay consistent, so what can I do now based on my situation in this year that can benefit me next year? So reviewing all that stuff. Some of the other changes they put in place was the excess business loss. This basically treats any business losses that you have cumulative on your personal return the same as an NOL. So you can only deduct up to a certain amount now. They don't allow you to maximize that, but those same NOL rules are going to come into play. So that 80% rule, where you can only deduct up to 80% of your taxable income, applies on your individual return as well. So that's something to consider going forward here. And then the main change that everybody's talked about from a personal perspective is the qualified business income tax deduction. This is the 20% deduction that you get on your flow-through income so long as you qualify. And what that means is that if you have taxable income from a married filing jointly return under, it's right, $415,000, you qualify for a 20% deduction on income generated from a business, from a partnership, S corp, or your Schedule C, so long as it's not a service company. And there's guidance out there as to what they determine as a service company. Now, if you're below the threshold, you still can get the deduction if you're a service company. So it's, again, this goes into looking at where you're at and planning, seeing if you're above the threshold, because you're not going to get the deduction if you have a personal service corp and you're above the taxable income threshold. I'm getting a little bit into the details of how this works, and I know that I've talked to a lot of clients about this because they're very confused when you get above that threshold, the limitations that they put on that 20% deduction. And basically what it is from a high level is if a business, you need to look at how much property you've bought and how much wages you've paid. Those are the two limitations that they use to determine how much of that 20% deduction you can get. So if in a real estate, you have a real estate business and you have $50 million of property, well, what they're going to allow you to do is look at that property, take a percentage that's 2.5%, and they say if that 2.5% is greater than the 20% of the income that's flowing through from that business, then you'll get the 20% deduction. If that 2.5% is less than the 20%, then you have to take the lesser of the two. So it's important to look at how much wages a business generates, how much property that business has, to determine whether or not you're going to be able to get the maximum benefit of that 20% deduction. So the other threshold, as I mentioned, the wages, is when you're looking at maybe it's we have some businesses that are a stucco business, and so they hire lots of employees. What we also can look at is when that income flows through, it's the lesser of the 20% of the income or 50% of those wages. And it's not the wages that of yourself, and it's not your W-2 wages, it's the W-2 wages of the business. So if you have a partnership, and they're still issuing guidance on this, what you have to look at is how much W-2 wages, how much wages have you paid your company, and then how much of that company do I own if I'm a partnership. That information, similar to the domestic production activity, should flow through to you on your tax return and be reported on your tax return, and you have to look and say, to see how much you're going to be able to take from that 20% deduction. So if you have these businesses, if you have flow-throughs, if you have partnerships, S corps, or if you have a Schedule C, it's important to start looking at this now to see, what you're going to end up getting and planning for that. So, we've got models that we've done that can calculate this, and we've done a lot of research. So, if you have questions on this area, you can see me afterwards. I can get into more detail. It's complicated, so I don't want to try and spend a great deal of time on it. But this is going to become, a hot topic. I know that they've issued some guidance on it already, but it's something important to note going forward. So Another thing I want to talk about is the changes to itemized deductions. Okay, most of the stuff that have changed has been pretty much standard. They lowered the medical deduction floor back down to 7.5% from the 10%. In most cases, most of the clients we see, this really is not going to make too much of a difference. You already have to have a lot of medical expenses in order to get the deduction for that in your itemized deduction. But the state and local income tax one, this has been the hot topic. It was a hot topic through the debates. Everybody's been talking about it. It's being talked about now. Still, there's states that are trying to work around it, allowing people to basically take charitable donations if they make it to the state instead of paying their income taxes, which the IRS has already come around and said, no, that's not going to work. We're not going to let you do that. But basically what they've done is basically limited it to $10,000. So, that goes from, if you're paying income taxes or you're paying property taxes, you're only going to be able to deduct on your itemized deductions $10,000. This impacts a lot of people in higher states like New York, California, some of those states where they pay high income taxes. They're not getting the benefit that they once did. In some cases, it's even putting people from being in itemized deductions into the standard deduction. So it's reviewing what your situation is. In the past, we used to talk about planning. People would delay, try and double up, pay their taxes at the beginning of the year and then at the end of the year so they could take the deductions, maximize their benefit. Well, that won't work anymore because if you try and double up your tax deduction and it goes over the $10,000, you're not getting the benefit anymore. Miscellaneous deductions, the 2% floor, that's gone. So it's something to consider if you have investment fees, tax prep fees, that's all gone. But they did get rid of the adjusted gross income limitation, so you're not limited anymore. Whatever's in your itemized deduction, you get. And then they've increased the child tax credit for qualifying dependents. These are just the basic retirement considerations, the years, when you start to catch up, when you have to take distributions. So it's always good to review these, know where you're at, know what you have to do from that. Review your distributions to make sure you're withholding properly. If you get a required distribution, make sure that you've got the proper withholding on it. Estate planning, the exemption is increased to $11 million. So if you're at that point, you want to start to plan, think about it going forward. $15,000 gifting, paying your medical deductions, making sure you've reviewed your documents to make sure that they're up to date. Other items to consider, they changed the leasehold improvements and the real property improvement rules where it's just one definition now instead of the three that they had. So it's, things there. Opportunity zones programs, we've got a lot of questions about this. There's this new program in the tax reform which allows for you to invest in, basically take capital gains. If you sell capital gains properties, you can reinvest that capital gain into a qualified opportunity zone and defer the gain. And not only defer the gain, but if you hold it for 10 years, the gain on that property that you've invested in is non-taxable. So things to consider there. We've had a lot of questions about that. The business entertainment expenses have changed. Technical termination rules were repealed, so no longer if you change ownership of 50% in a partnership, you have to have a technical termination and file multiple returns. Review the carried interest rules have changed. You can no longer convert IRAs to Roth IRAs right now because of the changes in the tax rates. Various other changes to moving expenses. You can't take your home equity line interest expense anymore as a deduction. They've increased where you can use your 529 plans for qualified tuition. The health insurance mandate's gone, so if you don't have health insurance, they've repealed that. And then again, it's not too early to start planning for 2019. So, start thinking about all of these things. I'm just going to quickly go through this because I know we're running out low on some time. But Tax Reform 2.0 was just passed by the House a couple weeks ago. There was 3 bills that were included in that, one of which extends all of the individual stuff and the things that were set to basically reverse in 2025. That one doesn't really have a lot of bipartisan support to it because it still has the state and local tax deduction in it and a lot of other things that were in there. But there are other ones that actually did gain some bipartisan support related to retirement plans, and more increases to benefits in the 529 plans. removing the required minimum distributions for less than $50,000 in your account, things like that. These are things to watch as we go forward. They're saying that nothing's going to happen before the end of the midterms. And for example, with regard to the 6760, which is the one that extends all that stuff, they don't really expect to get enough votes in the Senate to get that one to pass. So that one's going to be probably not expected to move forward. But the other two do have bipartisan support. There was over 40 Democrats in the House that did vote for both those bills because it's seen as more beneficial to middle-income people for the tax breaks and savings accounts and retirement plans. So these are things to start to think about, start to see as we get into another set of tax reform as we go forward. So with that.
Chris, Simon, you want to join us? Well, as I mentioned at the beginning, our thought was to have our kind of senior manager group join us up here today just to field questions and stuff for you. Simon, Chris, you want to introduce yourselves? And go ahead.
Sure. Simon Martin, I'm Managing Director of White Rock Advisors. So we're the investment banking arm, so corporate finance, sell-side M&A, buy-side M&A.
Chris Jeffers with CH Wealth Management. We do comprehensive financial planning, money management, and risk planning.
So one of the comments I'll throw out that Mark kind of touched on that we've seen clients already struggling with and thinking about for year end is with Wayfair. We've got clients that are selling in all 50 states. They don't, and because they're doing so much online and such a volume, they've never really had to account for the sales by state or by some local area and stuff. So there are some things you might want to go back and just ask people about. Does our accounting system simply allow us to extract that kind of data? What kind of hoops have we got to go through? Now that we're deep into this year, what if it happens and we got a report for 18? What do we do? How do we get that data? So just something to think about. That's, I'm gonna call it as you drill down into some of these other areas. Any other questions with regard to what Mark talked about? Yes, ma'am.
While you're talking about Wayfair, my question was, is that just retail that's not service?
That is, it's all sales tax. The service industry is going to get impacted by it as well. It's not just retail. Yeah, they're trying to find ways of bringing in revenue in any way they can. So it's just the standard of what determines whether or not you're in their state. And so if you're, have 200 transactions, it's from a retail's perspective, but they also put in there $100,000 in sales. That could be from services or from retail.
Yes.
Question, the new 21% corporate tax rate, does that also include personal service corporations?
Yes, there is a flat rate now, so they no longer
1% for them as well.
Yeah, so yeah.
Yes.
So are there 2 or 3 things you think are almost universal that you ought to make sure you do this year as opposed to next year based on the tax law change, which is pretty broad?
I
Or
think it's
how do you look at?
Yeah, I would start to look at how you deal with your capital asset expenditures because of the bonus rules, and start to see what it means for you from a business perspective, and to start to look at, because in the past people would at the end of the year they would just buy all their assets because it pushed them into a loss, then it wouldn't matter. But with the NOL rules changed, you have to consider that if you push yourself into a loss, the next year if you don't have those expenditures anymore, you're going to end up paying taxes because you can't use that loss to offset it. So that'd be one thing to consider from a business perspective. But most of the rules themselves, I think you're going to find it's the same kind of planning. It's making sure that you're just balancing it and looking at it and how it's going to impact you. From a corporate perspective, the biggest thing that you've got is the drop in rate. Now, another area, I know we have a lot of clients that have domestic production activity deductions. Those are gone. So if you were taking advantage of those before, it's good to review it to see what you were taking. If you had AMT credits, I know I have clients that have hundreds of thousands of dollars in AMT credits they've paid in the past that they've just been sitting there. Now they're going to be able to get that cash coming in the door because they're going to get it refunded. So there's some areas there to look at it from an individual perspective. I would say definitely look at your itemized deductions. Are you going to end up in the standard deduction, or are you going to remain in your itemized deductions? What was your property tax bill? Are you going to get limited on that? And then, again, the qualified business, if you have an S Corp, if you have a partnership, understanding those rules and whether it's going to apply to you. Because from a service corporation perspective, if you're above the $415,000 of taxable income for a married couple, you're not going to be able to even take the 20% deduction. It's off the table. So knowing where you're at, getting that taxable income down so that you can benefit from it is important. So I think those are probably, in my mind, some of the areas that we've been focusing on. The business interest limitation, that one as well. If you have a highly leveraged company, it's paying a lot of interest expense, how this is going to impact you. I have a large client in Florida that while their consolidated return is in like a massive loss, they don't have any issues from an interest limitation there, it will impact you from a state perspective. So if you have separate company filings, you may end up paying taxes in a state jurisdiction where you weren't before just because of these rules, depending on how it impacts you. So understanding a lot of these changes just in general, seeing how it's going to impact you, reviewing your situation specifically. We always tell our clients, like, they're always asking, what does the tax reform mean? Well, it depends. You know, you have to look at your situation, look at what's changed and how it's going to impact you. So, you know, for you it may be one thing. You know, you may have highly leveraged companies, so the interest limitation's important. You know, for somebody else, they may be taking large domestic production activity deductions. So it varies depending on the situation your company is in. You know.
You want to talk a second about investments and what people ought to think about for the end of the year, because I know that's a topic that we find a lot of people leave stuff laying on the table because they're not thinking about what to be harvested there.
Yeah, this year is a great year to rebalance your portfolio, whether it's a taxable account or a retirement account. For a lot of people in 401ks, you may have a target date fund or an asset allocation fund where they're doing that for you. But if you spread your money out amongst large cap growth, large cap value, international, emerging markets, and bonds, there's a big discrepancy in returns. When you look over the last 12 months, your large cap growth stocks may be up 15 to 20%. Your value stocks that invest in banks, utilities, financials, up half that return. And then internationals, flat. Emerging markets down 5 or 6%, and then bonds like your core bond fund, like your PIMCO total return, your Vanguard intermediate term bond fund, your aggregate bond fund, they're down 2 to 3% over the last 12 months. And so there's a great opportunity to sell something high and buy something low. I know most of us, we tend to sell low and buy high, but if you can go through that exercise and look at your portfolio and shave a little off of the things that are up 15 to 20% because trees don't grow to the sky. And usually these asset classes rotate. So international has their day in the sun for a few years, and then the U.S. market. It's been 8 years, 9 years that U.S. has been overpowering the international emerging market space. So again, these things rotate, things don't grow to the sky. It's a great time to hit a rebalance button in your portfolio. The fixed income side is really the hardest part in our practice right now, is generating that solid income and protecting the principal. When interest rates go up, bond prices go down, especially your longer term bonds. So when I mentioned that the intermediate government and corporate bond funds are down 2 to 3%, there are other places in the fixed income market where you can find value. That's like floating rate funds, short-term high yield, international bonds. So consider looking at other parts of the bond market as well.
Let's talk to about, I know that as interest rates go up, we're seeing less leverage being able to put on deals. That's affecting purchase prices. We're already seeing some adjustment taking place there. People talk about selling their company or even refinancing their company, what it does, things to think about. We've also seen a lot of people asking Simon and I about, when's the window going to close? When are we going to, where are we on the bell curve? You know, so talk to us a second about some of the conversations and what we see going on there.
Yeah, the market does a pretty good job of pricing in these changes and these increases in interest expense and the cost of debt. Typically for a good 12-month cycle. Beyond that, it's not very well priced in, and that tends to be somewhere in that 12 to 18 month is where most economists think is kind of the end of this expansion period where we're going to have some kind of pullback or some kind of recession. So there is a period of time where it's still a good window to refinance the balance sheet, to get some growth capital for growth, because we've got some good pricing in terms of the debt, but that is not a forever window. So it needs to be something that is accelerated in your mind and not continue to be pushed out, because there will be some, as we get into a pullback or a recession, you lose visibility to the market, and that gets priced in, and usually that gets a little bit more risky. And when it gets more risky, banks pull back, and then you don't get as much leverage, or you don't get as much coverage on your assets, which you can still get today. From the M&A side, as Greg mentioned, we're still in a period of time where we're able to maintain the kind of multiples that we've seen, but we anticipate seeing some compression in those multiples. What's keeping those multiples up right now is simply the amount of available capital. I think we're still somewhere around $1 trillion in dry powder and available capital. So as the structure of transaction changes, where they put less leverage on the companies because the debt's more expensive and because of this limitation on how much of the interest expense that they can deduct, they have the available capital to put to work because of the dry powder. But that will compress, and as that compresses and they're putting less leverage on businesses, purchase price multiples will come down. So we expect to see purchase price multiples start to come down in the next 12 to 18 months. So again, this needs to be something that's accelerated in your mind, unless you plan on keeping your business or maintaining it for another 7 to 10 years. So if you're in the 2 to 3 year window, it needs to be now, not a year from now.
Yeah, and from the financial reporting side, the things to remember that we want to call your attention is the revenue recognition rules, making sure you're ready for those, all the new lease accounting rules. One of the other topics that we're looking at with a lot of clients right now is goodwill. What do we need to do to make sure that as we get to year end, that we're thinking about how that looks, what happens, what do your numbers need to look like for bank covenant purposes, for whatever investor price that you're looking for, exit strategy versus tax. And for us in our practice, that's one of the things with all of our corporate clients. And most of our clients own and operate companies, so we see people across a whole variety of industries. But one of the things we really try and work with clients to balance is the whole thought process of what do you want the value of the company to be, what do you want the GAAP recognition to be, what do you want the tax to be. And we tell clients to accomplish probably the covenants and the valuation, you're going to have to work with him and pay some tax, okay? That's just a flat fact. It's very rare that we can accomplish all of them. But it's, again, it's working the models, doing the forecasts, working through that process. And we can't encourage you enough to sit down now and take where you are year to date and really try and work with us to drop it into some models so that we can play what if games with you and look at all the different 3 legs of the stool to make sure that we don't run the tax number down so low that we bust the covenants in some other area or we affect some kind of valuation. It's hard to sit, it's harder and harder to sell add backs and stuff and transactions and working through that. So we have to think about those things ahead of time, especially for 2-3 years out, because most QOBs are looking back now at least a couple of years, okay, trying to get some kind of trend. Other questions? Yes?
In regards to the business interest limitation, do you see that limitation affecting practically how much leverage companies want to take on? And the other question I have is, do you think there's anything that a lot of companies are doing in terms of leaving cards on the table to maximize what they can expense?
So from the corporate finance side or the M&A side, it will have some effect from financial sponsors and probably more of the smaller financial sponsors who are much more susceptible to the taxable income of their portfolio companies. So they, they're still going to put leverage on businesses because it allows them to spread out their equity dollars into more opportunities. So that's still going to be the case, but there might be some reduction in that amount of leverage that they, first of all, can get as the market moves away from them, and secondarily, because they're more sensitive to the taxable income of their portfolio companies. And then the other part of the question was, what expenses can businesses do?
One of the areas right now for the couple of years is it goes into the bonus rules, is that you're allowed to add back depreciation. So in order to prevent the interest limitation for the first couple of years of the rules, especially in where areas like real estate where it's high leverage, they're allowed to take that high amount of depreciation expense that they have and add it back to their taxable income to calculate that limitation. So you're going to see people doing that, but they did that in a way to allow especially real estate companies to start to deleverage. So I think what you're going to start to see is they're going to focus on those areas of expenses, but then start to deleverage to prevent it and start to analyze where it is. That rule has just been put in place, so I don't know how much analysis has been put on it to see where companies are really falling into it, to see how much of an impact it's going to have, because some companies are so far into losses sometimes that the interest expense doesn't really come into play. But there are other areas where it will. So I think that's going to be the area where you're going to have where people will focus on is trying to maximize capital expenditures to get the depreciation expense high, and that's where they'll be generating their losses.
Marcus, the interest expense limitation, is it a stepped limitation?
It is 30% of your taxable income. So
It doesn't change
no.
5 years from now?
No, the only thing that changes is down the line, the add back, because what it is you look at adjusted taxable income. So down the line, that add back of the depreciation to the taxable income goes away. And so you'll look at your adjusted taxable income, which is taken into consideration like interest income and floor interest expense, stuff like that, out of the case. But no, it's 30%. So if that interest expense is driving you into a loss, and that when you add back that interest expense, you're in taxable income, you're only going to be able to deduct up to 30% of that adjusted income number.
I'm gonna cut you off and ask you to ask your question, because we always try to stop at 9, but we're gonna be around. You know, nobody's gonna run off, so please feel free to grab us. One of the things I wanted to point out is what you see here happening today is the benefit that our clients get. Very few firms can bring these 4 disciplines into a conference room at one time when you're talking about a deal or a transaction or some kind of tax issue, or rebuilding a cap stack or a refinance or the acquisition of a company, whatever, or sale, whatever it might be. That's what makes the Chapman Hex family of companies unique, is being able to bring all of these disciplines in under one hat to help you, help your clients, work through that process. So please take advantage of it. If you want to catch somebody or ask or something comes later, please email us. If you want a copy of the presentation, that kind of stuff, let us know. We'll get them emailed and sent out to you. The video will end up in the vault in a couple of weeks. You can go back and look at what Mark said again if you want to refer somebody to that. If you want to share it with other people, let us know. We're glad to do that. A couple things about the future. November 13th will be our next Aspire event. It will actually not be here. We're going to have to move. We're going to go over to Prestonwood Country Club for one time. The building's got some other stuff going on here, and so we're going to move for that one day, and then in the spring we'll come back here. Please turn in your forms. You'll work through that process with us today. If you want CPE, let us know. They'll take care of that outside. You probably don't need a parking sticker, but if you do, let them know. They'll validate the stuff for you. Feel free to stick around for a while. One other thing too is we're planning out and looking. Our next event after November will be in February. We usually don't do a January or a December event. We are already planning on having someone to come in as a market expert to talk about the stock market, to talk about commodity prices, to talk about interest rates with I'm going to call it an economic forecasting overview. Should be very interesting with everybody wondering where's the top of the bell curve, what's everybody thinking is going to happen. After the midterms, year end, all the different things going on, it'll be interesting to see what everybody thinks when the dust settles. Again, thank you so much for coming. We really, really appreciate it. We'll be around to answer questions, and please take us up, use us as a resource. We're delighted to help.